This
Well,
conference will now be recorded.
Good afternoon, everyone. It is Wednesday, April 29th at 12 o'clock on the East Coast, and I am pleased to present our Wednesday afternoon WebEx. Today, we are going to focus on the future of life insurance products in a post-COVID-19 and low interest rate environment. Our featured speaker today is Nate Schelhaas, who is a vice president and actuary with Principal Financial Group. And he is going to be providing us with information that is going to be extremely valuable to your practice. And my partner, Gonzalo Garcia, is going to be guiding the conversation with Nate. And we're going to do this kind of as like in an interview sort of presentation. If you would like to ask Nate a question or have a comment, please do not forget that we will be available to take your comments and questions through the button where you can type in your questions or comments, and we welcome you to do so. So without further ado, I'm going to turn it over to Nate and Gonzalo. And Gonzalo, take it away.
thank you, Kathy. Nate, welcome. Thank you for being with us today. We're really excited to have this conversation because I think of all the things that we've been getting over the last 6 weeks or so, a lot of it is about product. And I don't think too many people know product and from an actuarial standpoint, certainly as well as you do. So thank you for joining us. Again, I'll just reiterate that if anybody has questions, I will be monitoring the chat box. So I will try to get to your questions as I can, and certainly as we weave them into the conversation with Nate. So Nate, again, good morning. Thank you for being with us. We have had a lot of questions that have come up over the last several weeks, as I said, and what I'd like to really start with today is mortality. I mean, the COVID-19 pandemic has caused a lot of we're over 1 million now in the United States, approaching 60,000 deaths. What is that doing to product, and how are you guys thinking through this?
Yeah, thank you, Gonzalo, and thank you for having me. I was encouraged when Kathy introduced me and put the actuary back there. I was watching the number of participants. I expected it to get cut in half immediately, and it didn't waver. So thanks to all of you for staying on the line. I do appreciate that, and I am honored and humbled to be asked to be a part of this because I do think it's important to have these conversations to give you some insight into what carriers are thinking. And as we'll talk through this, you'll see that many carriers are thinking different things, whereas on the underwriting side, it seemed to very quickly coalesce around different ages and different requirements and different ways to get around things. The product seems to be much different. So hopefully this will be a good and useful discussion. Talking about COVID-19, Gonzalo, as you said, there's that immediate impact of mortality, and nobody really knows what it means yet. And I mentioned before the call, as we were making sure all the technology worked, that I'm reading a bunch of different studies, and I'm reading the CDC releases total mortality statistics, and when people do analysis, it looks like excess deaths, so over and above what they were expecting, spiked a couple weeks before the COVID spike really showed up, leading people to think that, well, maybe COVID claims were showing up more earlier and we don't have a full count yet. And so just trying to distill all of that information to see what the true death count is difficult, and to determine what the true mortality impact is difficult. To know if it's a short-term or a long-term thing, it's difficult. And when you start thinking through all of those different implications, they're all different, right? If it's a short-term thing confined to April, May, June, let's say, that is a way different impact. And if it's an April, May, June thing, maybe takes a couple months off in the summer and then comes back in the fall, and we're going to see it recurring. That's a way different impact. So when you start to think through all of that, if it's short-term, really, there's not this lasting impact. It has an uptick in mortality, not just on the business we're selling today, but on everything that's been sold historically. And so you start to think through what are the different implications, right? If it's long-term, yeah, it's going to impact product. If it's short-term, it may not have an impact to product. And when you talk, it's not just the carriers that are looking through this. Our reinsurers are talking to us more now than they have ever. And they're talking to the underwriters, they're talking to product, they're talking exposure, they're talking retention. And so we're getting our information from them as well. And so you've got that mortality impact, which is uncertain to say, to say the least right now. But you've also got kind of the secondary impacts of that, right? You've got the economic impact that's resulted to the stay-at-home type mandates or the stay-at-home guidance and the impact to the smaller businesses. We've been driving around taking the dog for a walk, and you drive by these places that parking lots that were full of cars are now empty. Gas stations with their lights completely off at 8 o'clock. Right, that's stuff we haven't seen. And so you've got the mortality impact, but then you've got the downstream impact, the market, the unemployment, the interest rates. And so even what does that mean? How long is that going to last? People don't know. And so yet you make plans for, is it 3 months? Is it 6 months? Is it 9 months? Is it 2 years? We don't know. We had a call this morning talking with some of our employees who work in Hong Kong, and they've started to go back to work, but it's staged, it's slow. They talk about it taking a year before everybody could be back in the office, and some people may never go back because they don't feel comfortable. So when you talk about COVID-19, yeah, there's that immediate impact of mortality and what does it mean, but there's all that downstream stuff as well that we're working through. So it's a hard conversation. It's hard to know exactly what it means. It's even hard to know what's going to happen with product. And I think you're seeing that by different reactions in the market today.
Hey, Nate, it's, as I'm sitting here and listening to you talk, and clearly there are financial impacts for, employment and the economy and so on and so forth. And, while they may have some impact on how you're looking at product and pricing product and figuring out what principle is going to do long term relative to mortality issues and how you price for that, everybody seems to think that there's a fair amount more risk right now, or maybe not risk, but more impact right now relative to the low interest rate environment. So, two things really driving kind of what keeps you up at night. And I'm going to ask you that question here in a minute. But, at the end of the day, you've got a price for mortality and you've got a price for interest rates. And those are really the two, obviously profitability and some other things that are built into your product. But at the end of the day, those things are two of the most difficult things to figure out right now. And, is the interest rate environment even more challenging than the mortality environment currently? And how are you factoring that in?
Yeah, that's a great question, Gonzalo. And actually, the COVID one is an obvious question too, and one that we have to address. But with interest rates, it is a challenge. And mortality and interest rates are kind of the two things that we can't control, right? We can control our expenses that we have to price for. The profitability is what falls out. But mortality and interest are two things that we really can't control. And interest rates especially, right? There's no underwriting for interest rates. So many carriers establish long-term target interest rates and say, okay, in the next 10 years, we're going to get here. We're going to start where we are today, and we're going to get to some rate in the future. And you set that long-term rate, and your hope is that doesn't move a lot, that long-term rate stays where it is. It's a long-term view. Are you going to get to 4%? Are you going to get to 3%? You hope that doesn't move. But in situations like this that we're in, where the rates go from, they were up, they were pretty high 12 months ago, and then they just fell off a cliff down to less than 1%, and it just kept going down. It makes you take pause and look and say, is that long-term rate that I've set out there, is that still appropriate? Is that still the right rate to have? And that's what carriers are asking themselves right now. And those interest rates manifest themselves differently when you start looking at different products. Term isn't terribly sensitive to interest rates.
I'm sorry, Nate. I'm sorry. Just to touch on that for just a minute. I'm sorry to have interrupted you, but you mentioned interest rates were high 12 months ago. I mean, we've been watching interest rates go down for the last 30 years, call it, and even a year ago when the 10-year Treasury was sub 2. And then it creeped up a little bit into over 2, and then it just precipitously dropped under 1%. I mean, that's a shock move right now, and that really causes an awful lot of pressure in terms of your forward assumptions relative to interest rates. So how are you dealing with that? How are you dealing with that uncertainty?
Yep. And again, it's that long-term rate and trying not to overreact.
Yeah.
And so trying to be thoughtful in what we do and not saying, well, rates fell, so every price has to go up. Because if rates start to creep back up and get back to where they were 12 months ago, and I know they're not 3, 4, 5, 7%, but even 100 basis points more is helpful. And so it's sitting back and saying, what's our long-term view? Let's get information from our economists. Let's get information from the capital markets. Let's have a conversation as an organization on where we think those interest rates are going, because interest rates impact products differently, right? It impacts every product. Variable products, probably not as much. Term, not as much. ULSG, secondary guarantee, pretty significantly, right? We rely on interest earned on the reserves we hold to help price that product. On index universal life, not only your hedge budget, but the cost of caps goes up too with the volatility we see in the market. So trying to balance all of that without being the first, the only carrier to jack up rates ridiculously. Yeah. Right? Because you want to collectively move in a way that makes sense, doesn't completely disrupt the market. You know, there's a misnomer out there today on the how much insurance costs. So you don't want to exasperate that and make it worse. So it's really trying to balance, Gonzalo, in how we balance our risk through our whole portfolio, variable, term, IUL, secondary guarantee. How do we balance that interest rate risk with mortality risk, with persistency risk, with market risk, and trying not to overreact to some of those things.
Well, let's do that. I mean, one of the things that I wanted to get to during this conversation is, you know, you've got a lot of people on the phone that are wondering, you know, what should I be selling? What's going to be the price moves? What does term look like? What does GUL look like? What's current assumption look like? So let's go down product by product. Yeah. And when we were preparing for this the other day, you started, you know, we kind of had this conversation. So let's start with term. I mean, it's the easiest product. You had some comments about term, and I'd like to ask you specifically. We saw a move in Prudential, who got out of the 30-year term market. And almost literally the next day, we had an introduction by Protective on a 35 and 40-year term. You know, why the bipolar, you know, manic moves to that? And I'm not suggesting that one is good or bad, but they're just different. And you know, clearly Principal has a view on this. So what's going on with term, and what should the producers and the advisors on the phone be thinking about when they're making recommendations to their clients?
Yeah, and you know, we got asked that question internally by our executive management as well. Hey, we saw Pru got out of the 30-year term. Are you getting out of the 30-year term? And then, like you said, almost immediately, Protective comes out with 35 and 40-year term. And you look at that and go, what are they seeing differently? And again, some of it has to do with what's the risk appetite of that organization. Are they overexposed in mortality? Are they overexposed in interest rate? Are they overexposed in persistency? So they're looking at their risk profile, their block of business, and saying, what can I afford to take? The other difference I see between like Prudential and especially with Protective, you know, Protective's owned by a Japanese parent. And the Japanese have been dealing with low interest rates for 15, 20, maybe more years now. It's been a while. And so they've got more experience. And Protective, having ultimately that Japanese parent, may have some arrangement with that parent to offload some of that interest rate risk with them, whereas Prudential may not have that. And so these companies are made up so differently that it's sometimes hard to tell what's driving their decision. You know, we got pushed pretty hard on, are you comfortable with your 30-year term? And I'll tell you, we looked at it and said yes, especially if we continue to get it in the relative proportion to the rest of our business, right? When we look at our sales, we try to diversify and get a certain percentage from different blocks of business. And as long as we stay within a reasonable range, we get comfortable with it. Even with the secondary guarantee business, right? We've tried to dial that down a little bit, maybe to 10%-ish of our total portfolio. But if we can do that, we don't feel like we need to pull the product in the immediate future.
Right. And now term, I mean, there really isn't a whole, I mean, your profitability comes in mortality. I mean, you have more mortality risk in term than in any other product, but you also have certain long duration guarantees when you're talking about a 30-year term. So where do you see term pricing going in today's environment? Are we going to have long duration term products, and whether it's principal or really kind of a commentary about the industry, and are we going to see any price increases in term?
So
because you guys just dropped pricing.
Yeah. Yep, that was something we had planned,
Yeah.
and we talked about pulling it and not releasing those lower rates in light of everything going on, but we felt it was prudent. We felt, again, when we look at our block of business, taking on that mortality risk was appropriate. We've talked for years about the race to the bottom on term rates.
Yeah.
Right? Who's going to get there first? When are we gonna stop? And maybe we're getting close to that. I don't know. It's hard to see because if the market is moving to term, and I'd say it looks like it is in some ways, at least. Our app count has stayed strong with term, has actually gone up a little bit since this started. Term, I think people are more cognizant of their mortality now than they've been in the past, and they're probably saying, "Hey, I need insurance and I need it now," and term is the quickest and easiest. So I don't know exactly where it's going. I think at some point it's going to reach the bottom. It's kind of like the stock market. Are we there yet? I don't know. I can see it going down a little bit yet, but at some point I think it will kind of level out and people will get comfortable where they are and rates will stay pretty solid for a while.
Right. Okay. Well, that's so let's transition to the GUL space. So long duration guarantees, I mean, that's where your interest rate risk is, right? So you're reserving for those and you're trying to price those in an environment where you just don't know what's going to happen with rates for a while. So kind of how are you seeing the GUL market? Because we are seeing a fair amount of price increases on in the GUL space.
Yep. And even with GUL, you saw Symetra leave the market. Yep. And you saw Protective again introduce a new GUL product with lower rates than their prior product. And so again, even getting a feel for exactly what's going on there is difficult. I will tell you, because of that long-term interest rate impact, I do anticipate rates to creep up there. You've seen some of it. I think more carriers will come out with some rates in that same, I'm gonna say 5%-ish is sort of what we've seen, except when I think it was Pru came out with a very large increase recently. So I think you're going to see some of that just manifest itself in the market as those rates stay low and people get worried about, long term. If your long-term assumption was 4% and you've had to change it down to 3.5%, that definitely impacts your guaranteed business for sure.
Got it. Now on the current assumption side, and this is kind of where it gets interesting, because we categorize IUL in the current assumption block, if you will. So you've got interest rate moves, notably pretty major carrier in Boston just dropped some rates on their current assumption product. We're seeing cap rates drop on IUL. So you've got a fair amount of volatility in that space now, and certainly an impact on IUL. So let's bucket interest sensitive versus IUL just for our conversation's sake, just in the current assumption UL space, not IUL. What do you think is going to happen there? I mean, we're going to continue to see interest rate drops on their portfolios, and then what?
Yep, I think that's going to happen for a little while. I think that's going to make that product a difficult one, because when you start looking at fixed account returns, they're just not going to be all that attractive. And Gonzalo, one thing I should have said at the beginning is when we talk about interest rates, we always look at the 10-year rate as our sort of proxy for what are interest rates doing. But in any investment, there's really two pieces. There's that risk-free interest rate, which is your 10-year treasury, but there's a spread on top of that, right? When you invest in something, you're taking some risk. And so in addition to that 10-year treasury, you're getting a spread. And while rates have gone down, spreads have gotten wider. And so, you talk about the 10-year going from, just under 2 down to something under 1, dropping 100 basis points. At that same time, spreads may have widened 60 or 70 basis points. And so you're not feeling the full impact of the 10-year treasury because you're getting paid more on the spread, because those investments are a little riskier. So I don't think you're going to see an immediate big deterioration of earned rates or credited rates in those current assumption UL, but it will happen. And if rates stay low for a while, it will continue to drag in, kind of just lag itself in little by little, and you'll see a continued deterioration, I think, of that credited rate for current assumption UL type products.
And I assume that for those people on the phone that are advocates of whole life, I mean, that continued reduction in portfolio yields will ultimately then begin to have impacts on dividend rates, right? I mean, is that a fair assumption?
Yeah, absolutely. And so, I think you've seen that for participating whole life products that were sold 10, 15 years ago. Dividends have decreased significantly over time.
So let's talk about IUL, because there's another element on IUL, right? Is all the volatility in the market and how that affects caps and options pricing and so on. So talk a little bit about that, just to give people a feel of kind of what can we be looking at IUL going forward.
Yep, and really when you think about IUL, there's the real thing is how much of that risk can you hedge? And two things go into that. One is your hedge budget, how much can you spend? And that's really based on what you're earning on your fixed assets. So what would you credit on a UL contract? So as we talked about, that's going to go down. And so what you can spend goes down, and the price of those hedges is going up because of all the volatility.
Right. Which is where we're seeing the cap drops.
Right. And so you're seeing pressure from both ends, and so you're starting to see those cap drops. And my speculation would be is that nobody is going down as far as they need to immediately. They are saying, okay, if we go down 50 basis points, maybe 100 basis points, we can absorb that, and we can still buy caps maybe a little more expensively than we wanted, with the hopes that that volatility will settle down, the market will start to go up at a steady rate again. Those caps will become cheaper, and we won't have to drop caps. Those hedges will become cheaper, and we don't have to drop caps any further. So I think, just like the current assumption, I think you're going to see gradual changes and not big sweeping, cut caps by 200, 300 basis points.
Got it. But it could happen. I mean, if we continue to experience this volatility and this low interest rate environment, it's going to continue to put some pretty massive pressure on the caps.
Absolutely.
Right?
Absolutely.
Right. So just something to look out. Look out for.
The longer this continues, you're right. The more pressure everything that we've talked about is going to experience.
Got it. So finally, let's talk quickly about VUL. Then I want to ask you some questions that I think are really pertinent to the folks on the call. So you mentioned VUL is really a persistency risk issue, which was I didn't fully understand that when you said it, but it makes sense now after we talked about it. But for the benefit of the folks on the call, VUL, where do you see VUL going?
Yeah, so it's ironic, right? With variable business, when the market gets a little crazy like it's been, people get scared of variable products. And so they don't want to put their money there a lot in the market for themselves or in a variable life insurance product, even though it's probably the best time to do it is right after a big market crash. But we're seeing that some people are pulling away from that. I say persistency risk because the investment has very little risk for the carrier because it's in separate accounts, and so the policyholder bears all of that risk or most of that risk. And so there's some mortality risk, but it's mitigated by the large account values, and so it really becomes a persistency. Does it last 4, 5, 6 years, 7, 8, 9, 10 years, or do they get in and then get out pretty quickly, and then the carrier eats the kind of the compensation that was paid and the cost of setting up the policy? So by and large, it's a persistency risk.
Talk about though, because there's certainly an awful lot of premium being put into some of these guaranteed VUL products. Lincoln, Prudential, AG just came out with one. So when you have a variable sub-account product, but you have embedded guarantees, does the interest rate environment impact the price of those guarantees, and how does that play out? What's the interaction there?
Yeah, it will play out. It won't be as severe as a universal life secondary guarantee, but yeah, it will have some impact. And again, it could raise prices there. We do not have that product today. And so I don't know exactly how it works, but my expectation is with principles-based reserves now governing that product, it would behave similarly but less severely, or react similarly but less severely than a universal life secondary guarantee.
Got it. So we're coming up on 5 minutes or so left, and I just want to ask you a question about conversions, and I've got a
Yeah.
couple more questions for you. Conversions. I mean, I've spoken to a lot of advisors now, and they're saying, I'm going to go talk to all my clients who have term insurance today and tell them if they're looking to convert, they better do it now as opposed to waiting a year or 2 years. For example, if you've got somebody that has 3 or 5 years left on a term duration, should they be looking at converting now? Because, I mean, everything you've said is indicative of continued pricing pressure on the products that we have today, and that the logical conclusion, whether we're right or wrong, is that pricing will go up. So if I was a term policyholder today, would it behoove me to convert now at today's pricing, say on a GUL or something else, or not?
Yeah, I would say that in many situations, probably, and in other situations, maybe not, right? Again, I think it goes to what you guys do and what you do well. What is the need for that insurance? Is it a lifetime coverage? Is it 20-year coverage? Is it 15-year coverage? Right? You guys know that. And if they're looking at, hey, yeah, I really do need permanent coverage, yeah, now might be a good time because prices, as we discussed, are indicating that they're going up. Now, what we don't know is, are we going to stay here? Right? A lot of what we've talked about has been predicated on our rates staying low. Are we going to be in this environment for a long time? If we see that, hey, we come out with a vaccine or people go back to work or whatever happens, and there's a snap back to the economy versus this gradual, it might not change that much. And
Right.
so again, it's hard to know. And I would say that, what you guys do well is base it on what your client needs. And
Right.
that's one of the things that, Gonzalo, I've gotten to know you over the few years, just, the mindset that you bring is let's do what's right for our customers. Let's do what's right for our policyholders. And if now, and they need that long-term insurance, then yeah, I'd say go do it.
Got it. So, as you sit there in your, home now, but generally in your office, and you're thinking about, the next product that Principal wants to put on the street, or, what are you thinking internally in terms of, today's environment? But as you said, things will change, right, over time. And we don't want to create a knee-jerk reaction to product development or product pricing or whatever over time. But as you sit there and think about what's the next type of product that we either need to tweak because it's already on the shelf, or we need to build because nobody has it, or are you getting feedback from the field in terms of that, or are you just saying more of the field of dreams approach, let's build it and they will come? Kind of how are you approaching the product of the future right now?
Yep. So we spend a lot of time talking to our distribution partners. I would really call it a partnership. When we design products, we don't just design a product, throw it over the shelf and say, hey, go sell this. We used to do that, and then they'd look at us and say, we can't sell that, and then we'd all be frustrated. So we've gotten much more iterative with them, helping including them in the product design. And maybe the best example is guaranteed issue term, which we came out with last, or I guess early this year. Probably the worst time to come out with guaranteed issue term. But we heard a lot from the field that said, hey, we want a guaranteed issue term product. So that's what we designed. That's what we price. A lot of activity, not a lot of sales yet, but a lot of activity. And again, I attribute that to where we are today. I think the important thing is to provide people with life insurance. And I feel like life insurance is going back to its traditional meaning in this time, where I want to know that if I pay this, I've got whatever it is in the future. And people are going back to that. And so thinking about insurance in those terms, I think is how we're looking at it. What sort of guarantees are there? As long as I know that I pay this, I will get this death, or my beneficiary will get this death benefit. And then what can you do around that, right? If people are worried about long-term care, if they're worried about chronic illness, if they're worried about, how can you bring those things together? We have conversations about combining disability income with a life insurance policy, or what might that look like? And so we're having a lot of discussions, and we're bringing our distribution folks in to say, what's your reaction to this? What's your reaction to that? Let us know. If you think it's a terrible idea, tell us, because we don't want to commit the time and resources to do that.
Right. Right. Well, let's conclude. I don't have any questions that are popping up on the chat board. If anybody does have any questions, we have a minute or two left. But I'll conclude with this in the absence of any other questions from the audience. As an actuary, as somebody who's been doing this a long time and knows how to price and build product, if you were in the market today to buy a product, what would you look at? And and I get the whole suitability issue and all that stuff, but I'm talking about in terms of best product or consumer value today, knowing what you know about how products are built.
Yep, Gonzalo, I would look for something from a carrier I trusted to be around that had treated their policyholders right for the last 10 years, that has fulfilled its commitments, that has honored their cost of insurance charges. I would say I want a product that I know if I pay X, I will get Y. That's important to me in my situation. The other thing I'd say is that if I was looking to make an investment or had maxed out my 401k or something like that, I would be looking for a variable product today. One that's no frills. I wouldn't be looking, one with lower charges. I'd be looking at maximizing that account value growth via a variable product. So that's sort of the two I'd put front and center for me today. And Gonzalo, you asked me a question earlier about what keeps me up at night. I forgot to say, my 16-year-old just got his driver's license, and so that's primarily what keeps me up at night.
Yeah, what I heard you say, because I don't want to I don't want that last comment to detract from what you said, because I think what you said was really important. That was a political deflection, which was really good. And you're not from DC, Nate, but I am. What I heard you say was, I want something that has guarantees in it. I want to know that if I pay a premium, I will have a death benefit, whether that's a long duration term product or some form of whole life or GUL, something that has those built-in guarantees. And that's really from a protection standpoint. So
it is.
The actuary is saying for protection, guarantees, and for accumulation, what I heard you say is low cost, low expense, VUL. Did I represent that fairly? Okay.
You did, Gonzalo, and I didn't mean to take away from that.
No.
Because that's how I view the world. Is
sure.
I'm there's a reason I work for a carrier, right? I like a steady paycheck. I like to know what I'm going to get, when I'm going to get it, and that's how I view most things in life. That's how I buy vehicles. That's how I buy insurance. That's how I buy. That's how I look at things.
Right. I've got a couple of quick questions here from the audience, Nate. How does Symetra leaving the GUL business affect current policyholders? Good. So in the event of a carrier that says, okay, I'm out, I sold a ton of GUL, I'm out, is there a risk to existing policyholders? Is I think what that question is intended to ask.
So I would say that the risk lies with Symetra as an organization.
Right.
Not with that product or a specific policyholder, because they will still have to honor the guaranteed prices that they put out there. And we actually saw this, I would say 5-6 years ago. You saw a number of carriers get in the market for a little while and then out, and then maybe a year later get back in and then back out. They'd sort of fill up their bucket. And I think Symetra is just saying, hey, we're out for a while. My guess is you will see them come back in at some point. But the risk of Symetra getting out doesn't, on its own, present a risk to the policyholders. It's more about the financial viability of Symetra, which I assume is still fine, just given what you guys probably heard Monday, that their financial viability is still strong, and so the guarantees should still be honored.
Yeah. Well, we're over time, but I'm going to ask this last question, and there were a couple of questions that I wasn't able to get to, and I apologize for that. Very quickly, why variable versus index for accumulation?
So just for the upside, right? If I was looking to make an investment when the market goes down, your variable product allows for a greater upside. Your IUL has, limited at whatever that cap is, 10%, 12%. And so if you're looking at, the market maybe having a big correction and recovering a lot of what was lost, that's the only reason.
Got it. And then I'm,
as well.
Yeah, I'm going to end with this question. I think it's a little bit of a softball. Does Nate drive a Prius?
You know, Nate's hobbies are golf, hunting, fishing, and I have 2 kids that play, or both my kids play sports. So I actually drive a Ram 1500, so I can pull a fishing boat, pull all my stuff in the back of it without moving it around.
Great. Well, Nate, listen, thank you so much for your inputs and your insight on this. We're very grateful for your time, and we're also very grateful for everybody on the line today. There was a lot of interest in this call, and everybody stay safe. Kathy, back to you.
Nate, thank you so much. Gonzalo, to you as well. Again, thank you to everyone. I want to remind everybody that the third WebEx in our 3-part series of pandemics, products, and economics is going to take place on Friday, May 1st at 12 o'clock. That WebEx is going to feature Brooks Tingle, the president and CEO of John Hancock Insurance. We are delighted to have been able to secure Brooks for this WebEx. It's sure to be 30 minutes of lively conversation and interesting information that will be relayed. So with that, I want to again thank everyone. Please stay safe and healthy this week. And obviously into the future. If you've got any questions, comments, concerns, if Agency One can help you in any way, please reach out to myself, to Gonzalo, to Ed Lesher, to Dennis Bartos, and to our amazing staff that stands ready to help you with all of your needs. Nate and Gonzalo, again, thank you. And with that, we are going to conclude this WebEx. Take care.
Thank you, everybody.
Thank you.
All right, thanks, Nate.